Two oil tankers get hit in the dark of the Persian Gulf, oil shipments stall, and within hours, the world's markets have lost $3.2 trillion in value. That sounds like something out of a political thriller, but it's a real number pulled out of your retirement accounts and the broader economy by a very real war between the United States, Israel, and Iran. And if you're living on a paycheck, a pension, or a fixed income in the United States, this story doesn't just live on a map or a stock chart. It shows up at your gas pump, in the price of your groceries, and in how safe you feel about the money you've saved for the next 10 or 20 years. U.S. and Israeli strikes on Iran, and Iran's retaliation have turned one of the most important energy corridors on the planet into a shooting gallery. Two tankers moving through the Strait of Hormuz, the narrow mouth of the Persian Gulf, were attacked, and shipping companies did the rational thing in a war zone. They slowed down, they rerouted, or they stopped altogether. Traders looked at that and made a simple bet. If less oil can move, prices have to go up, and Brent crude, the global benchmark, jumped sharply, with reports of 8 to 9% spikes in a single burst and prices hitting their highest level in months. At the same time, stock markets around the world sold off hard, wiping out trillions in paper wealth as investors tried to figure out how bad this war will get and how long energy will stay expensive. If you want to follow how moves like this show up in your bills and your job, make sure you're subscribed to this channel so you don't miss the next chapter. All of that can sound distant, like something for traders and diplomats. But if you're someone trying to keep your job steady, make a car payment, and not watch your retirement melt away, this is a lot closer than it looks. When oil jumps that fast, gas stations don't wait for the peace talks. They start raising prices within days. Analysts are already warning that pump prices can jump 20 to 50 cents a gallon in the short term just from this kind of disruption and fear. And diesel, the fuel that runs the trucks moving food and goods across America, usually climbs right alongside it. For a family on a fixed income or a tight paycheck, that's not an abstract index. It's the difference between filling up without thinking and asking yourself which trip you can skip this week or what you have to cut out of the grocery cart to keep the tank full. So, what exactly happened out there between the US, Israel, and Iran that could reach all the way to your kitchen table? Over the last week, US and Israeli forces have carried out strikes inside Iran, targeting military sites and infrastructure, and Iran has fired back with attacks on Israeli and US-linked targets around the Gulf. In that tit-for-tat, those two tankers in or near the Strait of Hormuz were hit or threatened, and suddenly, one choke point that normally carries a big share of the world's oil exports turned into a risk no shipping company can ignore. Energy experts told reporters that if these attacks continue, production and exports from Iran and other Middle Eastern countries could slow dramatically or even come to a temporary halt. That possibility alone was enough to send oil and gas prices sharply higher and knock markets in the US, Europe, and Asia into the red. Because the part almost no one in Washington is saying out loud is what this does to people trying to hang on to a paycheck, a home, and a basic sense of stability over the next 5 years. Let's slow this down and translate the numbers into normal life. When you hear that oil prices surged 8 or 9%, or that Brent crude jumped to the highest in months, that's not just trader language. Every dollar added to a barrel of oil shows up in the cost for refineries, and then in the cost of gasoline and diesel they sell to wholesalers, and then in the price you see on the big sign at the corner station. 20 to 50 cents more per gallon at the pump means that if you drive a pickup or SUV and fill up once a week, you might be paying $5 to $10 more every week. Stretch that over a year, and you're quietly spending a few $100s more just to drive the same miles you did last year. For retirees on fixed incomes, that's money that has to come from somewhere else in the budget, maybe less eating out, maybe cheaper food, maybe delaying a medical visit they would have rather scheduled. Now look at that $3.2 trillion wiped off global stock markets. Different reports treat the exact figure differently, but the direction is the same. Markets across Europe, Asia, and North America fell together after the strikes, with major indices down 1 to 2% in a day, and some Asian markets down even more. 3.2 trillion is such a big number that it barely means anything by itself. But it helps to think of it this way. That's the value of countless retirement accounts, pension funds, and index funds, including those held by American teachers, firefighters, factory workers, and people in the private sector who simply bought an S&P 500 fund in their 401k. For you, it's the difference between opening your retirement statement and seeing it up a little, or seeing it down again after you thought markets were finally calming down. It's the uneasy feeling that every time there's a new war headline, the savings you spent decades building are back on the chopping block. This is not just about speculators, it's about the basic math of the American economy. When oil prices stay high, the cost of moving everything goes up. Food from farms to warehouses, clothes from ports to stores, medicine from factories to pharmacies. Truckers pay more for diesel, and those higher costs eventually get passed along in the form of higher prices on the shelf. If you've been wondering why your grocery bill has been creeping up even when the headlines say inflation is cooling, this kind of conflict-driven energy spike is part of the answer. It acts like a hidden tax on every shopping cart and every delivery. At the same time, higher energy costs can feed straight into inflation statistics, the very numbers the Federal Reserve watches to decide whether to raise or cut interest rates. When oil and gas get more expensive and stay that way, it can push inflation higher again, or at least stop it from falling as fast as people hoped. For you, that shows up as mortgage rates staying up instead of drifting down, credit card interest staying painful, and new car loans staying expensive. If you're a retiree living off bonds or savings, higher inflation quietly eats away at what those fixed dollars can buy. If you're still in the workforce, higher rates make it harder for businesses to borrow and expand, and that hits hiring. Now, some people online are saying things like, "This is just a temporary oil spike. It will all go back to normal soon." Or, "The US doesn't need Middle Eastern oil anymore, so these wars don't matter to our economy." It's important to clear that up. First, yes, oil prices can be volatile and can fall back if tensions ease. But what we've seen in the past is that every big shock leaves a little bit of a scar. Prices rarely go all the way back down to where they started, and businesses and consumers adjust to a higher normal. Second, while the US produces a lot more oil than it used to, the price you pay at the pump is still tied to global benchmarks like Brent crude, because oil is traded on a global market. When Middle Eastern supply looks shaky, the global price rises, and American producers sell into that higher price. You don't get a local discount just because the oil is drilled in Texas or North Dakota. Another myth you might see is the idea that war is good for the stock market, or defense spending will make up for any losses. It's true that some defense contractors and energy companies see their share prices rise when conflicts escalate, but broad indices in sectors like airlines, shipping, and consumer goods often take a beating when fuel costs rise and uncertainty spreads. We've already seen airline stocks sink after these Iran-related strikes because higher jet fuel costs cut into profits and make it harder to keep ticket prices low. That matters for you not because you own airline stock, though many people do through index funds, but because it can lead to higher fares, fewer routes, and cost-cutting decisions that affect workers in those industries. There's also a comforting line that sanctions and pressure will only hurt Iran, not consumers at home. In reality, sanctions and conflict around oil-producing countries often ricochet back into global prices. When traders expect that supplies from Iran or from countries that share pipelines and shipping routes with Iran will be reduced, they bid up the price of every barrel that can still reliably reach the market. That doesn't just punish the target country, it penalizes everyone who buys oil, including American families and businesses. It's like closing one lane of a highway. You can still drive, but traffic slows, and everyone in every lane gets stuck in the jam. Let's zoom back out to the bigger chessboard. Why is the US involved at this level with Israel and Iran in a way that can shut down oil flows and rock markets? Part of it is long-standing alliances and promises, commitments to Israel's security, efforts to deter Iran's nuclear ambitions, and a desire to show that the US still has control over key regions after years of debate about forever wars. But every missile strike, every naval deployment, and every escalation also has a price tag. Warships, fuel, munitions, and deployments cost billions of dollars, and those bills are paid by US taxpayers either now or through added debt later. When conflicts raise energy prices, they can also reduce economic growth, which ironically makes it harder for the government to raise revenue without raising taxes. If you're living on Social Security and a small pension, you may not feel like you're in the same story as admirals and oil traders. Yet when higher energy costs slow the economy, it can pressure Washington to either trim other parts of the budget or borrow more. That raises questions about how sustainable benefits and programs will be a decade from now. Inflation also matters for Social Security's real value. Cost of living adjustments try to keep up, but if energy shocks push prices up suddenly, there is often a lag before benefits catch up, and that lag is paid for out of retirees' pockets. So where does this go from here? There are a few broad paths. In the first scenario, the US, Israel, and Iran all step back just enough to save face. The attacks on tankers stop, traffic through the Strait of Hormuz becomes risky but mostly open again, and oil prices cool off from their highest spikes. In that version, the war headlines stay loud, but the direct economic damage for US families looks like a painful but manageable bump. Gas prices higher for a few months, groceries and delivery costs a little steeper, maybe a brief dip in your 401k that slowly recovers. It still hurts, but it feels like a bruise, not a broken bone. In the second scenario, the escalation continues or even deepens. More tankers get attacked or threatened, shipping companies avoid the region entirely, and insurance costs for any ship that dares to go through the Gulf shoot up. Oil flows drop sharply, not just from Iran but from its neighbors that share terminals and routes, and the global price of oil stays high or climbs further. That's when we move from a bump to something closer to an economic slow crush. Gas prices don't just jump once, they stay high. The cost of diesel keeps squeezing trucking companies, who respond with surcharges and higher prices. Airlines keep fares elevated. For individuals, that's a long, grinding pressure on budgets, especially for people who drive a lot to get to work or live in areas where everything is shipped in from far away. In that escalation scenario, central banks like the Federal Reserve face a nasty choice. Either tolerate higher inflation for longer, which erodes savings and fixed incomes, or keep interest rates higher to fight that inflation, which makes borrowing more expensive and can push the economy toward recession. Neither path is painless. If you're still working, a recession means rising risk of layoffs and fewer raises. If you're already retired, higher inflation and volatile markets make it harder to plan and could force you to dip into principal just to keep up with basic costs. The third scenario isn't just about this immediate crisis. It's about a longer-term shift. If war-driven disruptions in the Persian Gulf become a recurring theme, if shipping lanes and energy infrastructure are seen as permanently vulnerable, big players like China, India, and the European Union will keep accelerating efforts to diversify away from that region for energy and away from the US dollar for trade. Over years, that could reduce the unique leverage the US has enjoyed as the world's main financial hub and reserve currency. For American workers and savers, losing some of that leverage could mean higher borrowing costs over the long run, less room for Washington to spend without triggering inflation, and less ability to absorb shocks like this without your bills rising. None of this means you should panic every time you hear oil prices surged on the news, but it does mean it's worth treating headlines about tankers and strikes as signals, not background noise. If you're sitting at your kitchen table, looking at your paycheck on one side and your bills on the other, you can see why this isn't just a story about ships and missiles in a faraway sea. It's about how fragile the system is that keeps your gas tank full, your grocery shelves stocked, and your retirement account growing instead of shrinking. Here's a clip-sized way to think about it. Every missile fired in the Gulf can ripple all the way to your local gas station. War doesn't have to hit US soil to hit your wallet, and every time leaders decide to escalate instead of cool things down, they're not just gambling with ships and bases, they're gambling with your cost of living. Another way to put it, for a standalone thought, $3.2 trillion vanished from markets because a couple of tankers got caught in the crossfire. That's what global dependence on one region's oil looks like. It's not just about who controls the map, it's about who quietly pays the price when things go wrong. And one more short segment to hold on to, when you hear that oil only went up 8 or 9% in a day, remember that for a lot of Americans that's not a statistic, it's the extra few dollars they can't spare. For the people already juggling rent, medicine, and food, that slow squeeze is what war feels like from a distance. So the question this leaves you with is simple, but uncomfortable. Do you think this strategy, a war that can shut down oil flows and knock trillions off markets, is really protecting American workers and retirees, or is it quietly making life more expensive and more unstable for people like you? If you want clear, no-nonsense breakdowns of how moves like this show up in your paycheck, your gas bill, and your retirement, make sure you're subscribed and have notifications on so you're here for the next chapter in this same story.